IPO, or initial public offering, is the process through which a company goes from private to public. Before an IPO, a company has certain restrictions and benefits exclusive to private companies. For example, private companies do not need to report financial statements publicly and have less government regulations to meet. However, as private companies, they cannot participate in raising capital through stock sales. These companies are usually restricted to raising capital through friends and family, or through institutional investors like venture capitalists and private equity firms. Once a company gets to a certain maturity and valuation, usually around $1 billion, it may choose to launch an IPO as a strategy to raise capital from public investors. Once a company decides to launch an IPO, it must go through certain steps to officially become public. Number 1, select an investment bank to advise on the IPO and serve as an underwriter. Number 2, the underwriter performs due diligence into the company and drafts documents for the company. Number 3, the company and underwriters decide on a number of shares and an initial share price based on the valuation of the company. Number 4, once the IPO launches, the underwriter releases analyst recommendations and may purchase shares at or below market value to stabilize the price. Number 5, transition to market competition where company news, public financial statements, and market forces influence the share price. All of these steps serve to create a final product of a public company, allowing individual investors to buy shares in the company. As a public company, executives can raise capital more easily, use public financial records to take on more debt, and attract better talent with competitive compensation packages that include share distribution.